Before I go into too much detail, I think as South African investors, it's quite a challenging period for us at the moment. We've had fantastic returns last year from the local equity market, to a large extent driven by performance in gold and platinum shares. But as Kevin alluded to, it's not all good in South Africa. There are lots of challenges one needs to consider. And through this presentation, I will reference back to this challenge being a South African investor, but also the opportunities in South Africa, and also talk about diversification as a key concept that's very important. Now, just to give you a brief overview for those of you that are not as familiar with us, we're one of the largest DFMs or multi-managers in South Africa. We've been around for over 2 decades. This is the investment team that looks after your funds on a daily basis. Quite a few local team members, as well as team members like Kent, Dave, and Carl, sitting in the UK and on the Jersey Islands. So comprehensive teams, strong team covering various areas of investments. Now, before you get scared, I'm not going to suck up time today talking about process and philosophy too much. But I think the key thing to remember is really point one, two, and three on this process slide. For us, when we construct portfolios and working with Morebo over the years, the most important thing when you start out with a portfolio is defining the objectives of one's portfolio. Now, for the Morebo solutions, there are two clear objectives. Firstly, in the longer term, we want to be competitive versus industry peers. Els Corneille and Ashley and the advisors will really struggle to be competitive versus their competitors. The other thing that's very important for us, and that's probably the most important for for clients, is long-term wealth creation. And how do you do that? Well, it's a simple answer, but it's quite difficult to do. Is you have to beat inflation consistently in the medium to long term by a specific margin, and that margin depends on the type of risk profile a client selects. Now, depending on the risk profile, if you happen to be in the solution where we target CPI plus 5, which is typically a high equity balance solution with close to 70 to 75% equity, that does come with volatility. The market pays you over time that real return of 5%, or the assets that we buy pay you that real return because you're taking on the risk. It's that risk that provides that opportunity. Now, the second thing after defining the client objective is also figuring out what is the right asset allocation. I said the market or the assets in the market pay you that real return in the long term, but how do you know which are the assets that pay you the higher real returns depending on your risk profile? So that's where we do a lot of work. And then lastly, I'll touch on the manager research and portfolio construction briefly. Now, asset allocation, you don't have to really understand the slide. I'm more than happy to take any one of you through it in more detail, and Corneille is very familiar with it, and the rest of the Morebo Investment Oversight Committee. But we do an optimization exercise every year. We use over 100 years of data. It's in fact 125 years of historical data on asset class returns. We use forward or expected asset class return assumptions, and we push all this data into a very sophisticated optimizer that then generates the ideal, or we call it the optimal asset allocation to achieve different expected returns. So going back to my example of trying to achieve CPI plus 5 or aiming for CPI plus 5 over the long term, you can clearly see, if you can see my mouse here, to achieve those returns, those high returns, and these are gross of fees in the axis down there. So one has to deduct all the costs associated with investing, but roughly to achieve a real return of CPI plus 5, one needs sizable equity allocations, and that's around 70% in equity. And then the optimizer suggests you need a bit of bonds, and you need a bit of SA bonds, SA cash, a bit of property helps in that diversification, etc. Now, again, not really that important for you to understand the detail, but this is really to illustrate that you need to take on risk in the long term to achieve your objectives. As soon as you start getting too much of this blue stuff, which is SA money market, as soon as you sit too much in cash and income type assets, in the term, your real return expectation drops materially, and it starts if you're fully in money market only, over time after fees, it's highly unlikely to achieve any meaningful full real returns. Now, this is an important step for us. We call it our true north. We don't necessarily go to asset managers or invest directly into these proportions, but we know over time this is broadly our roadmap to achieve the long-term success. Now that we've defined the objectives, which we do for every portfolio, and we constantly review it, we know more or less for every type of risk profile what's roughly the best asset allocation in the long term, and the next step is to find the right asset managers to then put in a portfolio to blend into a solution to match roughly the asset allocation we need to achieve. Now, this is where we spend most of our time. Our research team did some analytics last year. If I recall correctly, 5,000 hours was spent on manager research, sitting in due diligences with these managers, report backs, asking them what their latest views are, understanding their processes, philosophies, etc. And this isn't a comprehensive list, but what I've got on the screen here is some of the key managers we use. So we've partnered with the likes of Coronation. We use their balance and defensive balance funds, their income fund. The biggest asset manager in South Africa, 91. They're one of the managers we use extensively across the solutions. ABAX, a manager more recently included in the multi-asset portfolios. We've got 361, exciting boutique. Lorium, another boutique. Truffle, another boutique. So as you can see, we've got a few of these big asset managers. We like to call them the cruise lines or the big ships. They're slow, they don't turn quickly, but they're steady and they get you there. They form the core of the solutions. And then we've got these speedboats, the 361s, the Loriums, many of these boutiques. They're fast, they can rotate in and out of shares, especially bigger shares. That's often difficult to sell in the market. And they can create that extra dynamic. And that to us is a perfect intersect of diversification amongst managers. You can also see some of the offshore managers, Sands Capital, Sanders Capital, some of them based in the US, some of them based in the UK. And through the solutions we've constructed for Morebo, you get access to these offshore managers, what we think are some of the best asset managers in the world. JP Morgan, another big one there, that you get exposure to and that we've partnered with to using those solutions. I'm going to show you one last quant slide. So once we've selected this database or library of managers that we use, we have to figure out what's the right combination. There's no point for us to go and buy two managers that do exactly the same thing because clients won't get the diversification. So we use various statistical techniques and tools, and I'm just showing one of the many techniques. One of my favorite ones is the dendrogram, where we test these managers and test their relationships to each other, how they correlate and behave relative to each other. And one could see some of the managers in the industry and some of the ones we use, like ABAX Balance, they sit quite close to a manager like Kermisa. They used to be called Kagiso Kermisa. Allen Gray Balance, you can see they're quite close to a manager like Denker and Melville Douglas. And this just gives us a good sense of picking managers that diversify, that stop rated according to our list, and that tick the box of having the right asset allocation to fit into our construct. So what's the end result? So the end result, and I'm using one example here, the Morebo Long-Term Capital Growth Portfolio. This is a typical high equity balance fund. And you can see the array of managers we've got in this solution that we've designed in conjunction with the Morebo IOC. And you'll recognize those names. Many of them I mentioned already. 361s, ABACs, some of the boutiques, Allen Gray, Coronation, some of the larger managers. Well diversified across these managers. You can see some of our offshore, etc. But very happy to take some questions on this as well. Kunai, please interrupt me as we go along if you've got any questions. Now, performance, the stuff that really matters, obviously. And before I show you the performance of the range, I thought it was important to just provide context for last year. As at the end of February, over the last 12 months, SA equity delivered a staggering 55% or just under 55% return. Uh, I mean, that's been a phenomenal return from the local equity market. It's in stark contrast to our experience on the local equity market just before the elections in 2024. And it was mainly driven by gold and platinum shares. Obviously, with tensions in the Middle East, subsequent uh, concerns around Trump's presidency and whether the US dollar will continue its trend. Really, a lot of concerns started there, and the gold price started rallying all the way to $5,500 in early in the year, and that's what's pushed this gold price so high. However, many of our clients ask, but why did our funds not return the 50% that the local equity markets return? But the important thing is we don't create SA equity portfolios. Yes, we've got it, we can create, but we are guided by Regulation 28 and various regulatory requirements, as well as the CPI plus mandates that we agreed with Morebo, and we think that's the right thing to do in the long term. You can't put all your eggs in one basket in the local equity market. I mean, I want to use a scenario. Last year, Liberation Day with Donald Trump. Who would have thought, after all the tariffs Trump implemented, that the local equity market would rally so hard? In fact, there were talks of sanctions against South Africa at that point in time. Imagine, and I believe it wasn't too far, it wasn't too far off. But imagine sanctions being implemented in South Africa. You would have seen a minus 50% return or minus 30% return from the local equity market. So we try to be highly diversified in the solutions to beat those real return objectives over time. Last year wasn't a great year for global markets, and to a large extent, it was because of the appreciation of the rand. Global cash and bonds delivered negative returns, and global equities barely squeezed out a positive return after accounting for rand appreciation. So once we put this multi-asset package together, how did the solutions perform? Now, firstly, I mentioned we compare ourselves versus industry peers, and we've got a long successful track record of beating equivalent peer group averages. Uh, and over time, we've done that for the solution. Unfortunately, last year, we left a little bit of performance on the table relative to industry peers, as we were underweight gold and platinum marginally. However, relative to our main objective of creating wealth for clients, we did a fantastic job. As an example, carrying on with my um, long-term capital growth fund or solution example, the solution delivered about 21% after fees, and over the last 3 years, 13.7%, and since inception of this particular range, about 12% return per annum. Now, if you look across the range, fairly good returns to the income solution. And bear in mind, an income solution's got no equity in there, maybe a tiny bit of prefs here and there. 12.3% return last year from the income solution. So we're very pleased with the outcome of the solutions. The flexible long-term capital growth portfolio, that's predominantly an offshore portfolio. Now, I mentioned earlier, offshore assets virtually gave you zero return. This portfolio with 60 to 65% offshore produced almost 17% return last year, or over the last 12 months rather, after fees. So very happy with performance over the last 12 months. However, as you all know, things changed rapidly in March. Now, we haven't finalized the March numbers, but early indications are that the income solution marginally down, probably less than 1% down in March because of the bonds it hold. And then the multi-asset solutions, the rest of the solutions down probably between 2 and 4%, depending on the risk profile. Now, again, I mentioned South Africa being quite a risky asset class in isolation of South African equities. The SA equity market was down 17% at some point during the month. When I looked this morning, it was down around 10%. And there's quite a lot of positive news in the market at the moment. Hopefully, gets us closer to zero performance for March. So overall, just illustrating the benefits of diversification in a tough month like March, really helping the solutions and not giving us too much of the good performance over the last 3 and almost 5 years. Yes, good
Rico,
night.
sorry, I just want to jump in there quickly. So the way that you assist us by building these models, what we want to achieve with the models is not ever to be the best performing fund, and also never to be the worst performing fund. What we are aiming to be is always to range in the top quartile of all the managers out there with a lesser volatile experience for the clients. Um, I think that is something that we you guys assist us with, and if you can just perhaps touch on those points on why how do we achieve that by consistently doing good for our clients and not have that extreme volatile and crazy ride.
Exactly, Kunal. That's exactly it. I mean, it's a fool's game to try and pick the next winner. For us, it's all about picking a range of good asset managers, partnering with them, diversifying them into a solution, and over time get a smoother return. Now, that doesn't mean if markets are down like they are this month that the solutions can't have a negative return in the short term. But what it does mean is we're not chasing the most recent winners. Yes, we've got some of these recent winners in our solutions, and Truffle is a great example of that. Truffle and M&G have had phenomenal returns, the likes of Laurium 361 as well. But we're not necessarily now just putting more money into or more of the client assets into these outperforming managers because we know markets go through cycles. A manager like 91, their opportunity solution, probably one of the most successful solutions in the long term in South Africa. They've been the worst performing fund or one of the worst performing funds over the last 12 months and the worst performing one in our solution. That said, we're not now exiting 91 just because they underperformed. Last year's environment was just not in their favor because they prefer not to be overexposed to the volatile gold type shares. And I've spoken, and I'm going to chat a bit more about gold, Corday. But when I say asset managers are invested in gold, they're not necessarily invested in physical gold. They're invested in gold companies that's leveraged to the gold price. So if the gold price goes up 50%, these gold companies can go up 100 to 150%. If the gold price drops by 20 or 30%, and we've started seeing that already in March, these companies can be down 20, 30, 50, 70% very quickly. It's not unheard of in the gold sector. And that's why we don't chase the recent winners, because the recent winners were just the managers that were overweight gold. Now, there's an interesting, and sorry, I'm giving a lot of insights on this point because it's such a good question, Cornel. There's an interesting piece of research I've done, and my colleagues and our chief investment officer in the past have done similar pieces of research. But we found that in fact, if you pick the winners of the last 3 years, so the best performing managers in a certain sector or with a certain objective over the last 3 years, the chances are that they are, or the probability is higher than 50% that they are the underperformers over the next 3 years. Now, we don't invest like that necessarily, but just to give you an illustration that picking the winners over the last 3 years or the best performers is more often than not the recipe for disaster over the next 3 years. But yeah, through this combination, Cornay, we definitely think long and hard about downside protection. The underlying managers do a lot of work. They think about the markets all the time. It's not just us. You've got this, just to jump back, you've got this entire list of managers just in one of the solutions. Top minds in South Africa and globally. A lot of the offshore assets sits in that global flexible fund. Just all day long, just thinking about how to get the best return and how to minimize losses for clients in the market. I'm not going to touch too much on attribution, but good strong performance for us last year with the likes of Visio and Granite. On the income side, I mentioned Truffle. Truffle is an example, bought European defense shares last year as tensions in the Middle East started escalating. They bought those defense shares that did exceptionally well for us. The likes of Lorium were quite heavy in South African assets. Absa and a few of those that performed well, and Fairtree, one of the managers that were quite high in resources that did well for us. That's on the portfolio, and we can definitely circle backward now later for questions. But I wanted to just touch on our outlook. Now, I mentioned gold, a bit of a conundrum at the moment for South African investors. If we look at the local market, the JSE, about 28% of the JSE is now gold and platinum shares. So that's massive concentration risk. Basic materials is more than a third of the local equity market's return. Now, in this environment, and starting the year, and it ties up with your question, Cornay, how do we manage volatility in the solutions? Now, the general theme from the asset managers we hold in the solutions is that but we have to trim gold and platinum shares further. It's rallied really hard. And in the first quarter of this year, mainly in January and February, the managers started pulling back on gold and platinum. And that benefited us tremendously in March. Um, Gold and platinum has also started becoming a bit of a risk on type of trade, not necessarily a defensive trade. So that's the one thing the managers did. We maintained a sizable offshore allocation, and I'll touch on the reasons for that. But that's the other active decision we make, is to maintain sizable offshore. And as the rand appreciated in the first part of the year, we ensured that we kept on topping up our offshore exposure. And I mean, I can't wait for I know the March returns will be challenging for investors, but I can't wait to see the numbers, just to see the protection in action. And I mean, it's just creating phenomenal opportunities for the quarters to come for us. Now, Kevin touched a lot on oil. I'm not going to speak too much about oil, but that's the other challenge in the solution at the moment. And as Kevin explained, the biggest impact is really on inflation and GDP. Now, Kevin touched on a few points. We've been working on scenarios with our colleagues at Standard Bank, and very similar findings. Depending on how long this current environment lasts, we can see inflation easily go up by up to 3% per annum from the current 3.5%. So don't expect inflation to be contained. South Africa is still a very open economy affected by currency and oil prices. At the same time, growth, Kevin mentioned, 1% growth is really on the cards if the war in Iran continues or is extended, and that is quite a challenge for us. However, despite these negatives, one big positive for us remains AI. We are, and Corneille, you can attest to that. Every meeting over the last 5 years, we've got a slide or two on AI. AI just remains a phenomenal positive tailwind for investors. I mean, there's a few examples I show you on the right-hand side. A company like Bank of America, we know banks really well as South African investors. We've got our big banks here, and it's world class. But internationally, Bank of America solves 98% of customer queries via email, via call centers, etc., through AI without any human interaction. Amazon, we obviously use, most of us probably use, take a lot more in South Africa for our own online shopping, but Amazon is growing quite fast here. 75% of Amazon's deliveries are now assisted by robots that's driven by AI. So these are a few examples. I mean, coding, 30% of code is now AI generated globally. And for Anthropic, it is more than 70%. So just massive amount of code being generated. And in terms of adoption, last year, especially in 2024 and 2025, there were a lot of questions from investors. Is AI a bubble? Is it just something that's going to blow over? And I think this year everyone is realizing it's definitely here to stay. Now, if you just look at adoptions, a company like ChatGPT, just after 2 years, they've already got 800 million active users. And now we've got Claude and various other tools growing very quickly, or AI models growing very quickly. Another interesting slide on adoption. Overall, according to an NVIDIA survey that was done the last 3 months, 64% of companies globally now use AI, and 28% of the companies that don't use it are assessing how they can use it. And one thinks about financial services and tech companies, but healthcare is actually the biggest user of AI, with 70% of global healthcare companies, which includes pharmaceuticals, using AI, and that's through research, robotics, etc. Telecoms use it, retail, manufacturing there at the bottom lags. But I mean, one can just imagine how quickly they will catch up. And the big question that comes up is, you know, how do we ensure that we don't fall behind? And I think every single person on this call that's still in the job market, and um, potentially even have got kids or grandkids that's entering the job market, you really have to think long and hard about this. And how do we as companies and individuals make sure we don't fall behind the trend? And um, the topic today is not to tell you necessarily how we do it or how we think is going to evolve. But in our company, we do a huge amount of work. We get AI to help us with our commentaries. I think, Kunal, you and Sean and maybe Tancred over the years have seen some of the commentaries we've done with AI, and we're expanding that and just increasingly using tools to help us make better investment decisions, get investment professionals to spend less time on admin and more time on using the brain power to make advanced decisions. So that's really what we are doing. Two or so slides left, Corday. When I saw this slide, I thought I called the slide "Global Dynamics" in one slide. It shows you the global GDP adjusted for purchasing power parity, which is just adjust for the local cost in countries. And this gives you a good sense of growth in the world. And based on this measure, China is already the biggest economy. On nominal GDP, the US remains the biggest. So that already explains a lot of the trade wars we've seen the last number of years. The blockage of US, where the US is blocking chips going into China for their AI developments. So it explains a lot that's going on in the world. But what I want to use this slide for is to illustrate why we are so keen on diversification globally. And if you look at that, and this is not to dismiss South Africa as not being a good investment destination. It's really just illustrating the realities of us being a fairly small emerging market economy. We are only 0.5%, so less than 1% of the global GDP. And that's why we are such strong supporters of global diversification. Um, the benefits are you diversify away from the gold and platinum that I've discussed extensively. You're getting access to AI and technology that you've got very limited exposure uh, for in South Africa. I mean, we've got nice passion process, and that's about it for technology and AI shares. You get the chance to diversify into the East and emerging markets where a huge amount of the future growth is going to come from. And you still get exposure to the big tech names if you go internationally. And I mean, don't forget Europe. I use the example of Truffle going into offshore banks and defense shares last year, the likes of Renk and Leonardo, really adding value. That's a benefit of a DFM with good ties to strong local managers and strong international managers is the scope. Yes, in a year like last year, you potentially give up a little bit of upside, but in a month like March and in the long term, and like we've seen over the last 5 or 10 years, it's really the place to be long term. This chart just confirms valuations. South Africa, despite what I've said, and I'm not making a U-turn here on our view on global diversification. Despite what I've said, we still see South Africa as being very cheap at the moment. Yes, some of the resources shares rallied very hard, but the rest of the market is fairly cheap in our opinion, and this is confirmed by various valuation metrics. And that's why we're very comfortable for our managers to retain a sizable exposure to South African equities and to South African bonds that still yield around 9%. Emerging markets in general, the darker red line remains cheap on this forward 12-month forward PE multiple. This is just one valuation technique that's quite strong, but the managers all use different techniques to analyze companies locally and globally. The US definitely the most expensive market, a forward PE multiple of 20. So what that means is for current earning or expected earnings over the next 12 months, if let's just say the US is expected to earn $100 as a market the next 12 months, you're paying 20 times that for that 1 year of earnings. So it takes you 20 years to get your money back effectively, assuming no growth. But obviously, the US has got massive growth, and you're paying for growth, especially expectation in tech and AI companies. So to wrap up my presentation, um, although tragic, what's currently happening globally with the war or multiple wars globally, when we speak to asset managers, and we had Carl Leinberger, the Chief Investment Officer of Coronation in the office on Monday, uh, and he said they're just finding amazing opportunities because of the dislocation in the markets. When you've got a global crisis, a lot of the fundamental laws of investment goes out the window, and that creates active managers that we've got plenty of, especially if they're skilled, massive opportunities to create extra performance and alpha. I mentioned local equities, fairly valued and very cheap once you look beyond the resources. Great opportunities there. Offshore side, the chart and other valuation shows a bit more expensive, but you're getting such a broad diversification and AI exposure, which you can't be without, in our opinion, over the next 5 to 10 years. I think AI is going to a large extent, drive a lot of returns we get from the market. Offshore fixed interest, our least favorite asset class, but it showed its worth last or during the month. We still like to keep some of these assets that are good defensive assets like US government bonds, just really helps during periods of market drawdowns. And to tie up again to your earlier question, Cornel, so what are we doing? How do we add value? So I like to see ourselves a bit as the conductor of an orchestra. So we've got all these top managers playing their specific music instruments, and they're all brilliant in their own rights. But we need to make them play their music together and create this song uh, for our clients, or this music for our clients. And we think we've got great managers. We've identified one subtle change that will be effective going forward. We're tilting towards what we call adaptable managers. So I mentioned earlier some of the big asset managers with the big ships that move a bit slower. They're great for core and they get you to the destination. But increasingly, we see the value of these flexible boutiques and adaptable managers. Now, in Morebo's solutions, we started increasing exposure to the likes of Truffle, one of our top picks, small exposures to them. We've started trimming some of the bigger asset managers marginally. We made space for the likes of ABATs in the high equity solution. So increasingly, just getting more bang for our buck from these managers. But overall, very happy with the solutions as they are. And looking forward, yes, some tensions in terms of performance and volatility. But once you look through it, we're quite positive. And Cornelia, happy in the last few minutes to also discuss that a bit. Thank you.
Cool. Thanks so much for this, Rico. Yeah, hopefully, you guys will be pitch perfect going forward for the rest of the year and giving our clients very good risk-adjusted returns over these uncertain times. Whilst we're on I just want to refer back to the AI view. How do we get exposure to those AI companies within our portfolios? If you can then just perhaps just run over that. I take it it's in the standard flexible solutions of the global solutions that we have there. That's included there. I mean, of course, if you can just touch on how do we in our models get exposure to those AI options and AI
Yeah, definitely.
companies out there.
Yeah, Kunal, so there are a few ways Morebo clients get exposure. So firstly, we've got a direct offshore exposure through the global flexible solution. And then we've got various US and UK based managers. So the likes of JP Morgan is quite big in AI type of companies. We've got other boutiques called Sands, and Sanders, both US based managers um, extensive exposure to AI through their stock selection. So firstly, through the offshore portfolio, and when you say how we get exposure, pretty much every manager in the portfolio is looking at AI as a theme. There's no manager, or let me put it this way, any manager that's not thinking that AI, that you need to consider AI and it is something for the future, they won't even make it into our portfolio because we automatically think that manager does not think broad enough and has lost touch with reality. So that's the one part. The other one is we invest various of the managers we invest into the Coronations, Truffle, uh, Fairtree, etc. Many of those managers also manage a far offshore allocation. So we'll go and buy Coronations offshore or the balance fund. They call it the Coronation Balance Plus Fund, and that will have a circa 35 to 40% offshore exposure, predominantly in equities. And within that portfolio, they will make sure that they've got sufficient exposure. And I mean, I used the example of chatting to Carl Leinberger from Coronation in our offices in the week. We actually spent 30 minutes of our 1 hour meeting. No, we actually spent an hour of our 1.5 hour meeting with them because it overran, talking about AI and how Coronation is thinking about AI, how they're bringing it into their manager research reports. Um, how Carl, the CIO, told them all to listen to a new podcast around AI that just came out on Sunday, and he wanted the entire team to listen to that podcast. So we're having those discussions, making sure everyone is thinking about markets and economies from various angles, and that's how clients get exposure.
No, 100%. Thanks for that. So of course, this is on top of mind for almost all the clients who's on the call. If everything went well for the first 2 months of this year, then everything happened in the Middle East, and then there's some sell-offs, especially in the local markets, and people do tend to get nervous when events like this happen. Now, yes, we did speak on that, and it's maybe just nice for you to just comment on that as well, not in too much detail, but um, is this time around a bit different? Because if you look at 2022, the Ukraine-Russian war that was there, and it's still happening. Predominantly, Europe was in a bit of a pickle where and gas was a big problem, but it was Europe that was affected mostly. This time around, it's a bit different. It's a global thing. It affects oil, it affects gas, and affects fertilizer. Um, so at this time around, do we think it's going to be something similar, or is the message to the clients that this is very similar to what we've seen all the time in the past, where things are not going as one naturally hope and believes it will, but it will rebound, and this creates certain opportunities in the market or mispricing, as you mentioned earlier. Um, if you can just make one or two say one or two sentences on that, how do you attack that scenario? How would you tell clients what to do, what not to do in these
Mm.
situations?
Yeah, that's a really tough question. There are no certainties in the market, and the investment in the long term is about weighing up probabilities constantly and trying to make good decisions all the time. And you're not going to get all of them right. We often say if you get 50, between 55 and 60% of your decisions right, you're one of the top performing managers. So and I can tell you what the underlying managers are doing in the solutions, and I'll tell you our view as well. So the underlying managers like Coronation, like Truffle, they're seeing opportunities at this point. They haven't in a big way gone and increased their offshore exposure or increased their equity exposure or anything like that. But around the margin, they're rotating into shares that they think will will benefit from the current environment. They are upping equities in certain areas. So they're doing all these changes. So you've got 10 managers or more than 10 managers in your solution, all just doing making decisions around this event. Now, we are very highly confident that over time that will produce the best result. It doesn't mean we're necessarily going to get this current event 100% right, but the last thing you want to do is what many asset managers and many investors did during the COVID period. COVID equity markets devalued aggressively. A lot of asset managers got out of the market and disinvested from equities. And then when you get the rebound, it's almost impossible to time that rebound. You lost out completely. And we don't know when the rebound's coming, but we think this event will also uh, resolve, whether it's in the next month or the next 3 months or the next 6 months. And at that time, you need to be ready. And our managers haven't gone and sold equities aggressively. We've sticked with the current asset allocation roadmap that we designed. That I showed early on, we've more or less sticked with that roadmap. There's some tweaks. As an example, many of the managers are buying more inflation-linked bonds locally, because what happens is as inflation starts increasing, inflation-linked bonds is one of your most defensive assets. So they've started buying inflation-linked bonds in the solutions. Um, so Kunal answered quite a few things.
Yeah.
Not quite sure if I got to the meat
No,
of
that
what
no, that
you were looking
that's good
for.
enough for now. Thank you so much. So, Rico, we're just going to wrap up with one or two last questions. And I think you can just deal with it in one. This is uh, one of the attendees asked. So I know it's difficult, but I take it if you can perhaps, if you want to, make a guesstimate on local versus global. So, what are the return scenarios for the next 18 months given global conflict, and is SA insulated? And then a second question, which you can just touch on, is, and I take it's with when you make a move or a portfolio switch within, or a switch within the portfolios per se, what is the approximate timeline of a switch to be made in one's portfolio?
Um, Kunal, maybe we can just chat about that switch question after I've answered. I'm not sure I understood that question fully. But South Africa is in a nice position in that our resources and gold market, although I said it is highly concentrated and that's a risk. And I mean, we can only have to look at Nokia in Finland years ago to know the risk of being concentrated in a certain sector in an index. But that does act as a strong buffer for us when there are global volatility, because what happens typically is gold and many of, not just gold, but the commodities we hold locally act as that buffer. Something like coal is a big export. We export a lot of coal. So now the rand is weaker because of the tensions globally. Now our export market picks up because we export gold and coal and other commodities. So you've got that natural buffer. Doesn't necessarily insulate us, but it does provide some protection there. But overall, we don't necessarily think that's enough protection. You have to be diversified offshore, because as the rand weakens, your best performing asset classes are typically your offshore asset classes, and the rand weakens during volatile periods. In terms of outlook, to your point, I mean, hundreds of the best people in the world can try and predict the outlook, and
Yeah,
maybe one or two get lucky. That's how.
yeah,
But
sure.
I will tell you what we think. We think offshore mark. We think there's a lot of value in South African markets, so that continues doing well over. And 18 months is difficult. Maybe I know it's not what the client asked, but let's maybe stretch it to a 3-year period and assume we've gone through this current rough patch. Um, I'm confident that South Africa's equity markets can deliver on average 10% per year over the next 3 years. We're not going to see a 30% or 40% like we've seen the last year in a bit. But I'm confident we can do 10% per year. What can offshore markets do? Now, offshore developed markets where US tech is still quite expensive, but who knows what these tech companies can do? NVIDIA, every time they produce results, it surprises. The US, the S&P 500, they're busy with earnings season. Earnings growth is 13% per annum over the last 12 months. So I'll be surprised if the US, that in dollars, doesn't match South Africa. So I think that 10% number that many investors got used to over the years, that's a fair number for expectation in the years to come, because we already had this big rally. Um, SA versus global, maybe SA slight marginally outperforms global equities over the next 3 years, just because of that slide that I showed you on the forward P, where the SA market is still very cheap. The big opportunity, we think, and again, not necessarily 18 months, but longer term, is in emerging markets. I mean, the Chinese and in Asia and in general, um, it's just phenomenal what we're seeing there in terms of technology and the quick growth and catch up in AI. And those markets are cheap. So you've got this big global GDP growth expectation. The East is growing really fast compared to the rest of the world. You've got AI being a kicker for them, and they're catching up. And well, I've got no doubt they'll match the US in the years to come. And you've got the third component that quite cheap to other developed markets. So I think that's longer term a place to be, the place to be, or the place to be overweight at least.
Well, thanks so much for that. Actually, so Rico, so I just quickly want to answer a question for Gail. Gail asked, she's got money lying in a tax-free savings account, and how to deal with that and how to invest it. So I would probably suggest, and without having more information, if it is a long-term investment, I would certainly take on the risk for that. So, Rico, I want to leave you and thank you for everything. I want you to, if you can, um, leave us with one last note on our clients for your piece of advice for them for the short term and the long term. Thanks so much, and I will leave you with that for the last comment. Thanks so much for
Yeah.
joining us.
So firstly, Cornay and clients, thanks so much for the support. We really appreciate you attending the webinar today. Um, we think it's just we have to see this period through. Fortunately, as I pointed out, yes, unfortunately, there has been some value lost in the short term, but it's not material in nature, and we think it's an excellent opportunity to create long-term wealth. And our managers and us see plenty of opportunities looking forward. So best ways to stay invested.